Here are some investing keys. One key difference every investor needs to know is the difference between an individual investor and an institutional investor. An individual investor is the average person that goes on day-to-day life, doesn't focus his entire day on the stock market. An institutional investor is somebody who either professionally deals with the stock market, works for a firm or any type of other investment layouts, whether it's investment management or just investing in the trades on the day-to-day. The key thing is once you decide, hey, I'm not going to be a professional investor, I am an individual investor, you need to decide if you're going to be a passive investor or an active investor. A passive investor is somebody that doesn't, once again, engage in the market on a day-to-day basis. Their investments are kind of blindly going into either an ETF, a 401k, anything that is focused on long-term retirement or any long-term goals like buying a house. So if you're passive, you let the consistency of your investments do the job rather than going in and out of trades like an active investor does. Where active investors study the market, study the macro, the micro. They could be somebody who's just focused on the charts. They can be somebody that's focused on the fundamentals. But their main job is to reallocate stocks as they see the market change or trends come and go. So it is really important for every person to decide if they're active or passive, because this allows you to determine how much time you're putting into each trade. And most active investors, they don't focus on ETFs as much as an individual investor would. They focus on companies, businesses, innovations, and just the study of businesses. Where if you're a passive investor, you don't necessarily need to study because you can go into the entire market like the S&P 500. You're investing in the SPY, which is the ETF that holds, top 500 companies in the US, and you go in that route. Now, everyone who is investing should know these next bullet points I'm going to give you. But as an active investor, this is your bread and butter. You really need to understand market volatility, stock momentum, investment volumes, and liquidity. These are the components of reallocation, rebalancing that allow you to make these decisions on where the flow of the money is going for the entire market. And one key thing every investor also needs to know is that majority of active investing is done through algorithms, computer programs, and it's set up on these guidelines where they're analyzing news, they're analyzing trends, they're analyzing policies by the governments, they're analyzing macro shifts, they're analyzing natural disasters. Basically, these softwares that have been designed by these large firms, even way before AI was a prominent thing that we spoke on. That's just how most of the money in the world flowed. Here are 3 investing experts and leaders you must get to know. First, we have Kevin Green. Then we have DataTrex, Nick Colas. And then finally, we have Barry Ritholtz. These guys are experts at research and analysis. Some of their key skills are to break down the charts and do a deep historical analysis on what that means. Further on, they can look at option trades, they can look at futures markets, they can look at the day-to-day activities of the S&P, the Dow, the Nasdaq, and break things down on a way where they only help you. These guys are not out there to determine where you put your money, but to ease your road in investing. Now, Barry Ritholtz, he's a genius. He's a columnist, he's an investor, he's an author, and the latest book that he just put out, you have to read. The title simplifies the content, but the name is How Not to Invest. This book, it breaks down your whole journey on investing and gives you the determination and knowledge to basically stay on that path. One of his famous quotes is, when it comes to investing, you are your own worst enemy. And as an investor myself and knowing other investors, that statement hits hard because at any moment you can make a mistake, even if you have that knowledge, just because human psychology takes over. And the path of being consistent and knowledgeable and living off of your past experiences is tough on a day-to-day basis. And when it comes to investing, you're putting up your money. So you're taking high risk. Another quote of his that I love is, investing is an art form that requires probabilistic decision making using imperfect information about an inherently unknowable future, which that's just how humans live in general. But in investing, You put so much effort into learning about businesses. You put so much effort into learning about macro conditions. You put so much effort into learning about geopolitics. But at the end of the day, it's an art form. It's not truly objective or subjective, somewhere in the middle there, because you do have all that knowledge and all that content out there to go off of, whether it's historical evidence of the markets or the trends of other investors. The stock market has begun to shift away from the macro conditions, which is highlighted by the US and Iran war, and it's now starting to focus on earnings, which is a great reversal, but at the same time historically surprising. Looking at the S&P on the week of April 20th, 2026 to April 24th, 2026, it's above 7,100. Nasdaq is above 24,000 and Dow Jones is above 49,000. This reversal is surprising and shocking, once again, based on how severe things are getting and how severe things will get with the economy based on this war. All the losses from March have been wiped out, and people are looking up already, like this war is stopped or the negotiations between the US and Iran are going fine. Year to date, emerging markets are booming. Jeff DeGraff says we have to look at things on a rolling 1 year basis, which is more important. The year to date is arbitrary on a rolling 1 year basis. Developed market ex-US are up 48%. Emerging markets were up 55%. US is only up 34%. Once again, everything that's happening, it does not kind of make sense, but it's the reality. So investors with like global portfolios looking back at the rolling 1 year return are like, what crisis? I'm making tons of money right now and everything seems pretty good. I think the US underperformance is the externality with the political instability. Once again, it's a self-inflicting wound because of Trump and the Republicans. Every version of international stocks is beating US stocks on the year to date. Low volatility international is up 8.5% versus 3.7% in the US. International growth up 5.5%. That's versus negative 2% in the US. International momentum 9.2% year to date versus 1.3% in the US. Emerging markets just significantly performing the US markets. It began about a year ago because people are afraid about the economy and the direction of the shift between the Democrats and the Republicans. There was really no telling. So diversifying just seemed like the best route. And these emerging nations, they're doing really well. They're diversifying really well. They're innovating really well. And within their own nations and other Asian nations, they're trading really well. And then when we look at South America, Brazil is just expanding. Japan has its own thing going on. This explosive growth that we're seeing in emerging markets, it's very impressive. Year-to-date performance of emerging markets, EEM, is 15.85%, propelled by AI infrastructure and demand on robust tech earnings. Developed ex-US, which is EFA, 6.19%. It's kind of weighed down by stagnant growth in European economies, which is going to get hurt more due to the war, because a lot of the oil imports that they bring in from Russia and other Middle Eastern nations, they're going to cost them more. Looking at MSCI ACWI ex-USA, 7.55%. This reflects the blended performance of all non-US equities. It almost doesn't matter what stocks you buy and what style, what strategy, if you're in any way at least equally weighted globally right now. You're extremely happy looking at your portfolio, because whenever the US has gone down, the international stocks have kind of balanced you out. Basically, the trade right now is hold America and definitely diversify into internationals. And that is what's getting you a very well-balanced portfolio. Emerging markets used to only do well when commodities prices went up, and they did very badly when commodity prices went down. Many of them were commodity producers, but now they have varying large sectors that they've diversified into, whether it's retail, whether it's manufacturing. It's just booming all the way around. And their trade within their own nations in Asia and other third world countries is giving exponential growth and a long-term drive to keep pushing towards that direction. When it comes to options, momentum and volume are up, and these are accelerants to the upside for the entire market. This week, traded contracts exceeded 200,000 contracts. That's something that we haven't seen before. So it went from being heavily put side skew when we were at the lows. Now we completely shifted to the right side of the curve. Here now it is heavily call side skewed. We can see that in the volume, and it's evident that people are getting more confident. The economy can only be described by the word confusing because it's kind of all over the place with the war and with the data that we keep getting. And the way the market is moving, it seems like everything's being priced in. Historically, if we were in the position that we are in right now, like for example, in the 1970s, we saw two energy shocks. One of them, which came through the Iranian Revolution at the time. And at that time, Paul Volcker, who was the Fed chair, stepped in and slammed the monetary brakes. And that led to a severe recession. And the 1970s are still a relevant analogy to what's happening right now. But we've gone through so much since 2020 during the COVID era. We've had so many different shifts happen, whether it's shifts between presidents, tariffs, other issues with war and what happened in Venezuela. None of these things are kind of deeming the market to be fearful. And that's pretty surprising historically. As citizens of the US, we need to stop confusing the economy with the stock market. This is one of the biggest flaws of our leaders, our media, and the wealthy people, the 1%. The 24-hour news cycle will try to fool the people into believing this separation doesn't exist, and the Republicans and the Trump would love that. Josh Brown, who's an analyst for CNBC and The Compound, also an investor, was recently watching Squawk Box, which is a business show, said that Donald Trump made an appearance on which he said, "When I get back to 50,000. To that, Josh Brown said, "Not when the Dow Jones gets back to 50,000. Trump said, "When I get back to 50,000, which is kind of an affirmation of all the time that we spent saying, like, he really views the Dow Jones as an avatar for him personally. Like, he's completely intertwined with where the Dow Jones is trading. It's not quite the same as if he was like my transports, my beautiful Dow transports. He's an industrious guy, and it makes sense. It sounds funny. It sounds entertaining. Like, oh, Trump looks at the markets and brags about the success of the market. But for him to really look at the success of the country based on the stock market is terrible for the average citizen. The stock market and the economy, they function differently and measure different things. While they are connected, the stock market is a leading indicator of what investors expect to happen, where the GDP is lagging indicator of what has actually occurred. And the GDP actually shows you what the economy is doing and how the people are doing, more so than just the stock market. Now, there are other factors that are not calculated, which is happiness, just livelihood pressures being relieved and easing your life. Those measures aren't even calculated. Investors invest in the market determining where the economy is headed, not where it's standing. So that analysis that you hear on the stock market, it's booming. Oh, we're going to make so much money. The futures are looking good. CapEx investments are showing great, immense growth. All that doesn't really project where we are right now at this moment. The economy at this moment is separate from the stock market, and that evidence is we're looking at the jobs market in March. 178,000 jobs were created, which is a healthy economy. But in the sense of the Fed, this beat was concerning because now there's no point in cutting any of the interest rates. Because if jobs are maintaining, why would we cut the interest rates? Which, as far as the entire economy goes, is kind of being held hostage because we've been patiently waiting for jobs to be cut. But with the war and having high jobs, it doesn't make sense for the Fed to cut. So that's why the economy right now is good news, is bad news. And the stock market is heavily influenced by specific high growth sectors that do not represent the entire workforce. So if AI is booming, that doesn't mean manufacturing is necessarily moving and other jobs that are dominant in the industries of the US. As far as global versus local goes, GDP measures domestic production, but many companies in the S&P 500 are global. A company's stock might rise due to explosive growth in North Asia, such as what's happening in South Korea. They've seen up almost 60% year-to-date returns, which is insane. Even if the U.S. domestic economy is slowing, this precision and global exposure allows investors to decouple from local economic conditions by moving into specific international markets. So that's why earlier when I spoke about emerging markets are booming and you need to be diversified, this is the reason. The divergence in the stock market and real economy has profound implications for social stability and the growing divide between different economic classes. Since the stock market represents only a small portion of population, specifically large publicly traded corporations and institutional investors. Its success often masks the daily struggles of the broader workforce. For instance, cost of living versus asset prices. While investors may celebrate a relief rally or a boom in the market based on potential peace talks or future stability, the general public continues to deal with the immediate reality of raising their prices on a daily basis, like rising energy prices and record high gasoline costs, cost of food, cost of groceries, and cost at restaurants. The portfolio doesn't matter in the real world when it comes down to those day-to-day expenses. And the emergence of frontier AI models further complicates all of this because we don't know how many jobs AI is going to take away. What is going to be the productivity levels that it increases? How is society going to manage knowing that they don't need to work as hard? How is society going to manage that they don't make as much of an income as they used to or they should be making? The economy just moves separately from psychological pivots and the actual markets. No matter what happens, the algorithms will never stop. The wheels of the industry have a design made to react accordingly with the speed for the stock market. But the way society and life adjust to the economical shifts takes time and deteriorates slowly until we fall off a cliff blindsided by some major issue, a recession, stagflation. These major issues, we know they're slowly building up, but the day-to-day person, the average citizen, they don't have the time to keep up with this. So when it hits them hard and heavy. The way a stock investor thinks is completely different from the general economy and the general citizen. For example, if a business announces that they're going to do heavy hiring, they're going to increase benefits, they're going to give better wages, they're going to expand to do social causes, then more than likely an investor who's an institutional investor will sell that stock. But if a business comes out and says they're cutting payroll, they're increasing productivity, but at the same time, they're saving money on taxes, then an investor is going to buy that stock, which essentially an investor wants to see profit growth, cash flow growth, investment into capex, investment into new innovations. They don't really care about the lifestyle of the employees that are working in these companies. Now, obviously, they don't want them in terrible conditions, but as far as their lifestyle enhancing and their wealth growing, that's not important to an investor. So Donald Trump establishing himself as a stock market president is not good for our country. It is not good for our future. It is not good for those that are coming fresh out of college looking for jobs. His mentality is basically to fill the pockets of the top billionaires, the top corporations, because that's how he looks at America. He looks at it as his own piggy bank. He looks at it as something that's a game. He doesn't really do what he's supposed to do as president, which is to make the lives of your citizens easier, which is to make progression a part of any policy that you're embedding. To him, it's about the money that is coming in and the investments that are coming in, but he really doesn't care about the day-to-day lives of any citizen and how they move, how their costs are exponentially growing. That's how he got into office, but while he's in office, he's doing the exact opposite, and this is factually proven by the data and stats that are out there. Now the Fed. This Wednesday is going to be the last day Jerome Powell is sitting as the chair of the Fed. Going forward, it's up to DC to decide if Kevin Warsh will be ready by the time June comes to be in place to sit as the chair. Kevin Warsh coming in isn't going to flip the script completely. Now, Trump wants him in there because he wants rate cuts really badly. But when Kevin Warsh comes in there, he's going to have to debate with the rest of the members of the Fed and figure things out based on data, based on game theory, and establishing some type of analysis. He can't just come in there and say, Trump wants cuts, so we're cutting. My favorite business economist, Neil Dutta, he hates Kevin Warsh. I don't have a strong opinion on him right now because everything Neil Dutta is saying is based on his historical statements that he's made against the Fed, where I'm going to give him an opportunity to see what he does. I'm sure Neil Dutta is too, but he's not wrong about anything he's said about Kevin Warsh. And this is what Neil Dutta has to kind of say about the Fed's decision based on what's happening right now. He said if they're cutting before the end of third quarter, it would mean something must have gone really bad in the financial markets or the labor markets. You don't see it in the labor markets right now. You're pretty sanguine on what's happening. I guess You know there's some evidence that things might be picking up. You know, if you look at some of these experimental data sets like the ADP weekly number are improving, but there's really no indication that things are really accelerating. I mean, there's a lot of kind of optimism and enthusiasm around the labor market's reacceleration. I don't really see that, but it's not falling off of a cliff either. So you know that kind of where we are at is in the middle. He goes on further and he says what's going on in the Middle East is also juicing manufacturing activity. I think so. You have some strength in manufacturing on the flip side. You know, housing market conditions remain sluggish. So this balance between manufacturing, housing market, interest rates is been basically clouding up the space for the last 2-3 years. Even with all this going on, the war is once again causing all the issues. Nobody really knows if these meetings between the U.S. and Iran and Pakistan are going to solve anything, or are we just going to keep carrying on like this and just keep hearing about the Strait of Hormuz being blockaded both by Iran and the U.S. The ceasefire really doesn't exist because as soon as it was announced, Israel bombed Lebanon, and ever since then, there's been scrimmages between tankers and ships going between the U.S. and Iran. Both have attacked them, and there is no say-so on the mines that are in the Strait of Hormuz if they're really being pulled out, because Iran is saying if the U.S. does anything, they're going to attack them outright. So we're in limbo right now, and there are no real answers. One thing is for sure is, though, you can trust the Iranian government more than you can trust the U.S. government, because everything the U.S. government says has zero logic to it, and it makes no sense. Where the Iranian government, they're defensive, they're willing to negotiate, they're willing to ease the pain of the rest of the world.